Okay, good morning. Good morning. It is Saturday, January 12th. Just go over the LRT lines indicator real quickly again so everyone can get the concepts of what the indicator is trying to accomplish. There is a main median trend line median mode trend line. It's linear regression. So this is my secret level and it is dynamic, works on all time frames, weekly, daily, 60, 15. And what I've done is I've modified a Keltner channel above and below the median trend line that you can set with your own levels on the indicator. So you can control what levels you like. I use the Fibonacci 1.618, 3, 5, 7.5, sort of mimicking implied volatility levels. You can use an 8 instead of a 7.5. You can use a 4.5 instead of a 5. You can change these to put whatever you want. There's also some other settings that I won't go into right here. A fast channel, in fact, if you don't want to see that, or if you don't want to see the faster linear regression line, you just want to see your levels for these higher time frames. And that's what we trade to. Right? We can use these, the daily levels, to trade to, as well as if you're trading a 15-minute chart, day trading. Once you get an indication of the concept of prices moving, long or short, directionally, where is it going? And right now, because this is the mothership, the main LR1, price is coming back to 67, 62.25. But because it's dynamic, that might fall, so it might be a little bit lower. This number will change dynamically as it responds to the closing price. So right now it's 67.62 is your target for the reversal back down if you're looking for a spot to reverse, or you can look to see what price did prior to the sell-off, those prior tops. So it's either the upper 1 or 2, upper 1 at 70.11 and upper 2 at 72.25. But that's quite a distance from here, so I would definitely be just shooting for that first 67.62. So there's a little bit of a prediction for you on linear regression. You can see that momentum is moving to that level. Momentum is your leading indicator. So if you combine that with your other indicators, you might have a good trading system. This shows you those outer band areas. Anytime really you get between these two levels, the 3 and the 4, you can expect price to be pulling back to the mean or the mode, the LR1. And especially when they get, a prior touch on the level would be an excellent place to get back in the market. If you were long, people who entered right there are lucky bastards, right? So that shows you a little bit of a predictive nature, and you can come back in and see what I'm talking about. Here was the February sell-off, but it pales in comparison to this current sell-off because we have wiped out a year's worth of market data in comparison to those February and April sell-offs. We've wiped out a year and a half of data. So I would say through April, maybe of 17. Or is it actually, it's May of 17, wiped out all those gains since May of 17 on that Powell miscommunication of being everything on automatic pilot for the Fed. Just market did not respond to that and sold it off. So we got back to the bottom level and bounced hard. Do you see that on the weekly? Are y'all starting to see this? These levels are dynamic and they work on all time frames. This is the weekly chart. I can back it. Let me try to back it up so you can see weekly, daily. And another thing to notice that when the bands expand like this and get wide, you're trading from level to level, more of an up and down trader's market, versus this is where the QE kicks in and the market was just in an uptrend. See the bands contract, so you just want to go long and hold it. And this again is dynamic on all time frames. So when the bands are wide and expanding, you're trading from level to level, up and down, trader's market, volatility. And so the market knows where these out of bound ranges are, like a football field, right? So it responds to the same level over and over and over and over and over and over. So I rely on these levels because the algos know where they are. You know, you trade what the algos are responding to, as you can see clearly. I mean, if you can't see that, then I don't know what to do for you. All right, so the bands are expanding again. We're getting into that trading market. Here was the beginning of October. Up and down, up and down. You see they're going to the same level over and over and over. So from that level to that level, just hitting it, hitting it, hitting it, hitting it, hitting it, hitting it. So there's your trading range, right? Y'all see that? Then we broke through the level, created a new one, and it's just here's the Powell testimony, and you see that huge move down, broke through the boundary, got way out of bound. So that gives you a signal that we're moving in a new direction, directionally down trade. So there was your panic and panic and panic. We've got a little bit of a reversion to the mean going here on the third leg. And we got back to the second level above the LR1, but do you see how narrow and pinched, contracted those lines are, how squeezed they are together? That indicates that you want to be selling the upper 2 and upper 1 and the LR1 whenever you can, and get behind this move and then shoot back for that lower band and then take your profit. Don't, I would not trade this bottom stuff because it's going to come back. But you definitely, this is what we're trying to do when the bands contract for a directional trade. So that's like the golden goose. So now it bounced back up, got back to the LR1, got right back to the 2 up, got a little bit over its skis, 3 up, and then 4 up, got to the top band. So if you're going to be going short, you need to be paying attention. This is exactly where you want to be looking, because we're at the end of the football field. We're on the sidelines. We're out of bounds. We're going to be getting a penalty for moving too far out of the field, and there it goes. So whoever bought an entry short right here. Whoever got short, wrong here. Here it is. Whoever got short right there is the winner chicken dinner dude, right? So, because you're on your outer bound level, and look what it did. It just went down and down and down. Like I said, it took out an entire year and a half worth of market action in 3 months. And so where are they selling it over and over and over? The LR1, the 1, and the 2. So you want to wait for your closes, and then here would be a good way to get a trade going. And if you're wondering, this looks very small, you don't realize we're on a 60-minute chart here. Your day trades, here's your close, 200 points, right? That's a lot of money trading to these levels over and over and over. So volatility is different than volume trading. It's different than trend trading. You're trading volatility levels over and over and over to volatility level and taking your profit. Or if you're just looking for a swing trade location to get short for a swing trade, I mean, throw a 1 lot on and then wait and wait and wait is a good trade too. But use the same linear regression volatility level that's been used in the past on the chart time frame that you're interested in over and over and over. And so there would have been no down trade here because you had no down candle, right? So you would never have gotten short there. You would wait for your candle to close, remember? So we broke up, one level up, and kind of made it difficult to get back in short here, but that's what they did eventually. So if you were looking at this on a lower time frame, you might have gotten a couple of knockouts between November 1st and 2nd, but then it went back again. And then where does it go? We come back to these prior levels again. But so yes, you're trading volatility level to volatility level to volatility level. It's like a wash, rinse, repeat. Lather, rinse, repeat, rather. So here's your golden opportunity again. We're out of bounds. Slope, also remember, is key for this. But these patterns, repeating patterns, this out of bound trade is, here's another one in November. And got you stopped out on it, but if your stop, instead of being a tick above the price level, was dynamic to the band, so your stop is above that band instead, you would have gotten a little bit of heat on this, but the trade eventually did work out. So now you're at your lower level short, and I'm not trying to justify carrying the draw, but I'm just saying this market clearly was coming back to get those stops. So instead of going long, if you look down here at your momentum, you see how well the momentum took off back to the downside. And we know the result because it continued selling off. like I said, it took a year and a half worth of market data, and it wasn't until his December meeting when he came out and walked back his statements that we now corrected. So, but you can see how the market responds to these levels, and will trade within these boundaries over and over and over. So if you believe that we are in an uptrend, where do you want to be watching the market? Every time it gets to that bottom level, right? To go up. And you can achieve that on multiple intraday time frames, right? So 15-minute chart, there's a touch, get back long, all over here, get back long, or just wait for your slope to get back in and either trade the white slope of your linear regression with a candle to a level, or wait for those outer bound levels to get hit. Friday, market did not respond very much on that CPI report because it was really flat. So you got a flat market, and it just was not much to trade, except knowing that this level 2 on the 15-minute was holding. So anytime you got a touch on level 2, you might want to consider an entry on your lower time frame, and maybe you could time that with your other entry system, whether it's a stochastic or a divergence or a candle close or whatever you've got. But it just was level to level trading. Not much to it, very flat. In fact, it's just not even worth trading sometimes. Here's a 1-minute chart. Not even worth the effort, the bother. When you're up and down like that, you just get chopped up. So you have to know your context. We're back in data dependency. The Fed will not raise rates in January. It's already told the market it's not going to, probably not to this summer. So data dependence mean when we see a flat CPI report, the market's going to be flat, and that's exactly what we saw on Friday, in my opinion. We've got earnings coming out next week, and also an awesome lineup for the economic calendar next week. You can always hop over to the website, look at the economic calendar, and nothing on the calendar really for Monday next week, but Tuesday, Wednesday, Thursday, be sure and come into the trade room. We've got PPI, and then retail sales, crude oil inventories, and then Thursday, some real estate numbers, building permits, and Philadelphia Fed manufacturing, and more jobless claims. So we'll probably see some more claims come in for the government shutdown. So definitely a lot of tradable entries. And now that you've seen the dynamic nature of these indicators, the LRT lines indicator, you can use it with Bloodhound to create trade signals very easily. And I'll show you how to get some of these outer band bounce levels in the trade room next week, and just have it set up to trade the outer band level and trade to a location like the LRT1. So very dynamic, and I think it would incorporate very well with an existing trading strategy. Some strategies I don't understand the concept. So if I don't understand the concept, I think the system would fail. Other people swear by certain systems. So if it works for you, keep going with it. But maybe the linear regression would help you with your current strategy. I mean, that's what it's all about, right? Is getting the best trade decision at the time. And market context carries more weight than anything. But when you understand the concept of these levels and how far an algo will go um, to these volatility lines before reacting, um, gives you a lot, that gives you a tremendous edge in the market, um, tremendously. So I, and that has nothing to do, if you match this with RSI or stochastic, all the better for you. I can never get stochastic to work because it's a bounded oscillator and will stay flat and will also go above um, the 30, 60, 20, 80 or whatever over and over and over, and the trade fails. Too many misses for me to use stochastics. And that's why I don't use it. But you can't go wrong with this. Maybe if you were to incorporate stochastics with an out of bound level, it would be more beneficial for you. And then you can incorporate your level, your entry with this. So I'm saying, use this with your current system. Just don't discount it because you were unaware that it was here available. Again, um, when the lines are very narrow and contracted, just like the Bollinger Bands, expect a expanded range. When the lines are flat and expanding, expect bouncy, more consolidation and backfilling and bouncing from level to level, like you can flip it off of a dime on a curb and bounce those lines. Anytime you can get a level that you can bounce that coincides with a trend line or a higher time frame level, use it, right? Or divergence. There you go. So I'm using this to develop my algorithm in conjunction with my existing um, suite of Bloodhound templates. And hopefully we can start walk forward testing that algo in February 1st. So we can start getting our performance. All right, come see us in the trade room. Y'all have a great weekend and go football, right?